Hello, friends, and welcome to yet another edition of the Trading Justice Podcast, episode 210. All of our episodes are special, but this one, even a bit more so. A free Tacke Trading Coaches Show, courtesy of TackeTrading.com. If you are not already a pro member, enjoy the show, and then get to Tacke Trading and get 15 days for free on us with promo code JUSTICE15. Enjoy the show, ladies and gentlemen.
We got a great coaches show for everybody here tonight. We're going to talk about the markets, market updates. The question that I have for everybody is, in the last week, I've seen headline after headline, Dow down 9 consecutive days. Is the Trump rally over? It's almost like if the market does a retracement, everybody loses their mind these days. And so I wanted to talk to the coaches, and we brought on a very special guest, Tyler Craig. Everybody say hello to our wonderful coach, Tyler. Everybody say hello, Tyler. You guys all know Tyler. Awesome. Great to have him here. So we wanted to bring on Tyler and Gino and have a conversation on is that Trump rally over, or is this just an overreaction? I know I certainly have my take on it, but we're going to get into the details. We're going to look at the different sectors out there as well that's impacting the marketplace, and then we're going to get into the bull put spread. As Gino did his little discussion on the Trading Journal last week, and we talked about credit spreads the week before. We're going to talk specifically about the bull put spread, and the reason we're going to talk specifically about the bull put spread, it is the bull put spread that you enter when the market's at a support level. It's a wonderful time to enter into a credit spread, especially on the bull put side of the equation. And so Tyler's going to have a discussion about exactly what is the bull put spread, and then we're going to pull up not the Trading Journal, but we're going to pull up the Tackle Theta research guide, and we're going to research a couple of them based on Tyler's parameters. And then after that, we're going to get into rapid fire. So obviously we got an action-packed coaches show here, so sit back, have some fun, participate. Just by way of a couple of announcements, how many have you enjoyed Tyler's Technical Analysis 101? Anybody here watch that Technical Analysis 101? Loved it. Awesome. In the last week, we've already had 100 of our members. Okay, 100 of our members started and got done with the Technical Analysis 101 series, and the reviews are off the charts. And so, guys, if you have not had a chance to go over there, that is something that we did for you as pro members. We got more of them coming down the pike, so definitely check out the Technical Analysis 101 series. We are beta testing the Options 101 series right now for you pro members as well, and that beta test looks like it is going fairly good, and if we have to make some changes to it, we certainly will make some changes. And the number one update I have for you guys is an update on the website. We have began the groundwork, laying out the groundwork for the new Tackle Trading website, and we spent a good 6 hours designing it today. And guys, I'm going to tell you right now, what we're designing for you guys is a one-stop shop. Just a one-stop shop for you guys to get all the trusted information you need from us, trusted members, learning the same thing. And so we're getting excited for that as well. And obviously, I will keep you posted on that as we go further on, as we get going down a little bit more into the development of that new website. So let's kind of kick it off here today. I'm going to share my screen with you guys, and we're going to look at the market skyline. And so just give me 1 second. I'm going to share my screen. By the way, we are redubbing this as a podcast today as well, so we're excited for that. I want to bring in Coach Gino very quickly. Gino, come on in and say hello to the folks.
Hello, team. How you guys all doing out there?
Everybody's doing absolutely fantastic. Beautiful, beautiful. By the way, Steve, I saw you won your golf tournament. Congratulations, Steve. That is absolutely awesome for you. Great work. Maybe next time I'm down in your neck of the woods, you can give me a couple pointers because I do not win any golf tournaments there, Steve. Not one, not one, not even close. It's not. I'm not kidding, but anyways, let's go ahead and let's start with the S&P 500. Gino, obviously we got a little bit of a bounce today in the marketplace, and like I said in the intro to the show tonight, there's been a little bit of negativity out there in the market. Some of those headlines, the quote unquote, is the Trump rally over? That kind of sells the headlines. We saw some, VIX spikes, all of this jazz. We saw, just some overall negativity. But when I'm looking at the market in the last week, I'm saying, okay, we had one big down day and a lot of dojis,
Right.
a lot of dojis. So, in looking at the market right here, Gino, what is your read on the market right now?
Overall, Matt, long term still bullish. I'm going to call it neutral, but I'm still seeing the buying step in after a hammer 2 days ago. If you guys see that hammer on the moving average there, Matt, I'm not sure what moving average you have there, but anytime you
20
see
and
a
50.
hammer, especially look at that, 3 dojis in a row
Boom,
and a
boom, boom.
hammer, that's a lot of indecision. That's a lot of time the market's going, what are we going to do? What are we going to do? What are we going to do?
Yeah.
And then look at yesterday, or what we have right there, which is actually today. That's actually today, the 28th. Because you notice the futures already started on the cone
Yep.
there. So that's today. And that is a triggered swing low. Not a real strong one, mind you. But what I do when I see a swing low, one of my little tricks, beginner and advanced, you should be doing this, is trying to figure out, well, is that good volume or not? Was that on good volume or was that on bad volume? Well, I'm looking at the volume right now. What are you looking at? The futures right now, Matt?
Looking at the futures right now.
Yeah. So I'm looking at T-vol, dollar sign T-vol, and the futures are pretty good, about the same. I'm looking at your volume and on my charts too, and the volume's been below average the last 4 or 5 days. It's been kind of low, not great. I want to see a swing low and a follow through. So like Matt said, you can't jump in on one day. Why don't you show them what dollar sign T as in Tom VOL, dollar sign TOVL. That is the market volume right there. So on a follow through or a swing low or a trigger where you think this is the day to buy in, or any chart, you should be looking at number two most important thing, volume. So you got price action, which we saw in the chart, the swing low, and number two, volume. Is the volume there? And I don't know, Matt, are you impressed with the volume lately, or this isn't.
You know,
2 weeks ago
I,
was a lot better volume.
no, I'm not. I mean, we've been a little under the average normal volume. We were thrown off a little bit because of that big down day we had last week, coming into the coach show last week on Monday. So that's kind of thrown the volume off just a little bit. But no, I'm not impressed by the level of participation in the marketplace. But I will say this though, as the market is finding that support level in the S&P 500, you can kind of see it here on the spiders as well. As the market is kind of finding that level, you're starting to see the bulls kind of kick into high gear. And one thing that I do want to bring in Tyler to talk about here. Tyler, if you don't mind, come on in here. Let's talk about the VIX very quickly, Tyler. Tyler,
Yes, sir.
here just a couple, and the VIX is a measurement of fear. It's a measurement of volatility. But what I want to look at here is just in conjunction with what happened just a couple days ago when you had that hammer candle that Gino was talking about. So there's that hammer candle on the S&P 500 that Gino indicated. Here's the VIX. Now, the VIX spikes up, just gaps up pre-day. This is yesterday. Gaps up, but then throughout the entire trading day, and you can kind of see it here, spikes up, but then throughout the entire trading day over the next 2 days, it just comes down, 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 and down. What does that tell you when the VIX spikes up at the opening price, but then throughout the rest of the day, it shows no buying volume in any capacity?
Yeah, first off, can you guys hear me okay?
Yeah, you're coming in good.
Sweet. Well, so this is, if you look at the daily chart of the VIX, Matt, this is the first real spike we've seen in volatility year to date. And for those that are option sellers, volatility has been pretty low the entire year. And it's interesting that the first time you get a chance to sell expensive options, that's what the VIX is measuring, is options getting more expensive. So you get a little mini panic with that down gap in the market yesterday and the pop in the VIX. And, it's kind of an inflection point where it looked ugly yesterday morning. The market could have gapped down and just got pummeled. That we get fear in the market, we get the VIX to spike, and it could have just kept running. But market bottomed, right? Buyers came in and bought that dip, and option sellers came in and sold the high premium. So I think it kind of reinforces the fact that dip buyers are still in force. People are still taking advantage of selling these little spikes in the VIX. Yeah. I think it's just more of the same, and I think it would argue for this being a buyable dip over just everything going to completely fall apart.
Well, and kind of what my read on that was, guys, was with the market sitting at a support level and the initial spike in the VIX at the opening of the day yesterday, followed by no action, followed by nobody actually stepping in selling. I thought that was a pretty crystal clear opportunity for us to be a buyer in that scenario. Maybe it's not long term. Maybe it's not, when I'm talking about looking at this, I'm talking about the next few days. But I think it was pretty clear that the market was going to respond bullish today when the VIX just got absolutely plummeted after the spike at the opening price yesterday on Monday, followed by that hammer candle in the S&P 500. It was like the heavens and the earth are kind of aligning there for a nice little bull day, but that doesn't mean it's going to continue in that capacity, Tyler. Now let's look at this right here. Give me one or two reasons why you would be a little cautious as a buyer coming into here full force.
Sure. Well, part of it is it depends on your instrument. And that's the difficulty that we have in throwing out general market comments, is the way you manage is going to be different depending on if maybe yesterday you sold a bull put versus you bought a bunch of call options, right? But one of the reasons I think we all need to be a little bit cautious with this bounce is there is a little bit of overhead resistance at that 20-day moving average. Some of the other indexes, like the Russell, has broken support and is in a short-term downtrend. And so when you get these areas, when you get these indexes where they pull back but they break short-term support levels, the old phrase is old support becomes new resistance. And so there's always a chance on the rebound that you don't get much follow through. And doesn't have to do that, but you could see where if somebody did enter a bullish trade yesterday morning, you could see where they might be lightening up on positions as we start to test some overhead resistance.
Yeah, and I'm a little cautious with that as well, guys. I'm looking at a little bit of bearish negativity kind of overall. You have you got a little swing low right there. You might be sending in another swing low in this capacity as well. So I'm looking at this and I'm saying, okay, I might be a little hesitant in this capacity, but I do see more buying reasons than selling reasons. But I think the battle is raging right now. And does everybody know what I mean by that? The battle's kind of just beginning to rage.
And you know what else, Matt? Not to jump the gun here, but I think this becomes more apparent when you look at sectors.
Yeah.
And some areas did have nice pullbacks and don't have overhead resistance. Others, like financials, got just the snot kicked out of them. And if they break major support, this next bounce is a little suspect.
Well, and that's what I mean, guys. It's the bulls versus the bears. It's that constant battle between bulls and bears, supply and demand, buying and selling. You constantly have this undercurrent of battle going on between who's going to win that battle between the buyers and the sellers. And so I see a lot of neutrality right there, although I do see the bulls kind of seeing a little bit more reasons to buy than the sellers' reasons to sell, because everybody's been programmed to buy the dip, especially in the Trump rally. I'm glad you brought that up, Tyler, in terms of the sectors. Let's first of all, let's go to Tacke Trading right here, and let's look at a heat map. And obviously, we had a good day in the market today, but let's look over the last just month performance in what sectors have been doing good versus what sectors have been doing bad. And I'll just kind of highlight this. So if you guys are looking for a potential investment or trade out there, and we're talking about, okay, who's winning that eternal battle between buyers and sellers? Well, let's go ahead and let's look at a 1 month performance over the course of that last neutrality in the market. And you have a lot of you have consumer goods doing fairly good. You have utilities still doing fairly good. You got a lot of neutrality, in services, some red, some green. Basic materials have been in a bearish territory. Financial has been in a bearish territory. Healthcare is mixed out there. Industrial goods is mixed out there as well. And I want to quickly run through these sectors just in terms of the actual trend of them, guys. And I'm just going to quickly do this. You're looking at underneath the 20 and the 30-day moving average on industrials. The industrial play might, it's been about as strong as the technology play over the course of since November until today. I'm seeing some weakness in that industrial play right now. Basic materials is flat out neutral, seeing some head and shoulders formations in the basic materials sector. Consumer discretionary is still showing some signs of strength right here. And by the way, consumers, are they happy or sad right now based on the economic report we've been seeing? They're extremely happy. They're giddy. They're happy. They're still buying. We might want to look, and the trend in discretionary is showing that as well. So that might be a sector we might want to look at. The energy sector is, I'm not happy about that. I get that there. And Jacob, I'm not saying I do either, because this was the highest report we've had on consumer confidence since when was it? December of 2000, and we all know what happened in 2001. Right, in 2001 we saw the crash, and I'm thinking in the back of my head a little bit of the same thing, but it doesn't happen in a month or a week. It doesn't happen in a quarter. It will happen in time, and I'm a little cautious because when everybody's happy, usually Wall Street's getting ready to short everything, right? But at the same time, in short-term trading, we might want to look at that sector for some opportunity. Energy is utterly weak right now, but do look for that to move up into resistance. Technology is still showing strength. I'm still seeing a lot of strength in technology right now. I don't see that slowing down. Utilities, I'm seeing a little slowing momentum, but still showing overall strength. Looking at healthcare, guys, I might be looking at this as an opportunity to buy on a retracement on healthcare. Consumer staples, which are your food-based companies, I'm seeing an M formation. How many of you guys can see that murder formation up here at the top? Can you guys see that murder formation? I'm seeing that on consumer staples. That might be looking at an opportunity to short food-based companies. And then financials, guys, I wouldn't touch financials with Gino's money right now. So in looking at that, you you have some good stuff, you have some bad stuff, you have some neutral stuff, but it's important to look at those sectors, guys. And Gino, I want to bring you back in.
Yeah,
When we're looking at the market, when we're looking at the marketplace and we're seeing a little bit of equality or neutrality in between the bulls and the bears, why is it important to go next to look at those sectors?
because there's sectors that are leading the market and there are sectors that are lagging the market and holding it down. And you could kind of guess what those are. Looking at 9 major sectors like you do, Matt, those are the major sectors. And in my report this last week, I said I'm also looking at big industries like real estate. Go ahead and type in IYR, Matt, IYR real estate. Look at that. That's been something that might be a little, see the head and shoulders there?
Yeah.
That's something I'm watching to break down also with financials, because they're going hand in hand with this rate interest hike and all this other possible 2 more this year, which looks like it's a clear selling for that.
Hey, Gino, very quickly, in terms of this ETF right here, I was in, where was I last week?
Houston?
Oh, nope, I was in Houston the week before. I was in Jersey. Yeah, I was in Jersey. And I asked the class, I said, hey guys, how's real estate doing right now? And a couple of real estate investors like, oh, it's great, it's great, it's great. I'm like, I don't want to disagree with you, but the trend tells me otherwise, right? Sometimes we have a tendency to look at our own local situation, and real estate is very local driven because, I mean, real estate in Salt Lake City is killing it right now. Right? I mean, it's great. I mean, if you have a house to sell, it literally is on the market for like 2 days, right? I mean, it's just doing really, really good. But when you're looking at the national average here, Salt Lake City might be a little different than somewhere else.
Well, Matt,
And
I
looking
think
at this
it's on the
trend,
market
I'm not seeing it being great.
It's only on the
Say
market
again,
for
Gino?
days because you keep buying them.
Well, that might be true. There is. I'm doing my part for the Salt Lake City real estate market. Let's just put it like that. But at the but at the end of the day here, I'm looking at the overall national trend of real estate, and I see in a rising interest rate environment, and I'm looking at the trend showing a lot of weakness since they started talking about raising rates. And just over the last 2 days, you've had Fed members come out and talk about 2 to 3 more interest rate increases throughout the rest of the year. And if that happens, you're going to see some weakness in real estate. And you talked about that in your report.
Yeah, so I'm looking at the sectors, and when you're a beginner, it's hard enough just to understand and remember the trends of the markets, the 4 major markets. And then you have a harder time trying to remember the 9 sectors of the S&P. That's your XLs, XLE, XLB, all those. Then when you're real good and you've got, some good vitamins going and you're focused on this night and day like myself, you start to remember the 90 different industries around those sectors. So, it's really about, okay, what's happening to the industries inside the sectors, like financials. You can break financials into banks, brokers, real estate, and REITs, a whole bunch of different industries, credit lenders, all those things. You could break healthcare down into pharmaceuticals, biotech, hospitals, health insurance, all these different things. So it's all about, and when you do it, it's easier just to look at the sectors. And, Matt, that's really what I play is the sectors. Sometimes I remember, like you said, in 2000, the market was crashing. Everything was going down, and I didn't know how to play a bear market. So I said, what the heck is going up? It's got to be something to buy. Colleges were going up, actually. Online colleges, and it was a great industry to play. So it takes time to find where the fish are biting, is what I call it. Where are the fish biting? Just because they're not biting in this river, they got to be biting somewhere. So if you're bullish, you got to find a bullish sector. If you want to play bearish, you got to find a bear sector. If
Well,
you don't know what you want to do, find out where most of them are. Are they mostly bullish or bearish?
or you know what? Just go to the stock and options report every single week, and we'll
Oh
help you
yeah,
do
there
it
you
too.
go.
But little tag there. That's all that was. Just a little tag there. But no, the one thing I want people to understand that as a trader, as an investor, as a technician, when we're looking at something, we say something is bearish, it's because the trend is bearish. And it's amazing to me sometimes when people hear me analyze the marketplace and they're like, "Oh, Matt hates real estate." No, I don't. I just don't like losing money.
Yeah.
I mean, no, I mean the trend is going to be the trend is going to be the trend, and we got to follow the trend. But I would say, guys, the number one reason to look at sectors is see where the money's going, and
Exactly.
we want to follow the money,
Matt,
right?
have
We
you
want
ever,
to look at
you ever
those trends.
Harley Davidson?
I don't. I feel that's un-American.
Yeah, see, that means you hate Harley, right?
Yeah, no, you just don't short hog. In fact, I'm
I
glad you
don't
brought that
short
up
hog.
because that looks like a wonderful buying opportunity on Harley Davidson right now. Swing highs, sitting at support, hammer candle. I mean, thank you for bringing up hog. That's going to be the trade of the day in the rapid fire. Everybody say thank you, Gino, for telling a joke on hog that led us to a wonderful opportunity. Thank you, Gino. I appreciate that. Let's bring you back in very quickly, Tyler, and I want to get your take on the commodities market and specifically gold and silver. So we're going to look at gold very quickly here. We're coming up at resistance here, Tyler. What's your read on gold?
Yeah, if you had a 200-day moving average on there, Matt, you show it's button up right against it right now. So it's up quite a few days in a row. It's near a pivot high, a resistance level. So it's always tough to enter a new bullish trade, even if a stock's in an uptrend, if it's rallied up already 4, 5, 6, 7, 8 days and it's sitting right at potential overhead resistance, right? So the dollar has gotten whacked quite a bit over the past 2 weeks. That's helped gold, but I don't think you could chase here, Matt. I don't know that I would short it, but I think you got to wait for a better setup.
No, I agree, and we've seen these charts many times, guys, in the coaches shows, and you've heard us talk about this about when you make too far of a run into resistance, what typically happens for you veterans out there is as you make too much run into that resistance level, what do we typically see happen? It runs out of steam. Exactly. We see some type of sideways consolidation. We see it kind of form maybe a continuation pattern. What we typically see in this type of movement, guys, is it comes back down into support and then makes another attempt. And that's what creates the cup and handle pattern. That's what creates the ascending triangle pattern. Is
Inverted.
that type of the inverted patterns and whatnot. Sometimes the symmetrical triangle patterns. And so, guys, when there are certain telltale signs, and I want to ask everybody here, who's here within the last 2-3 weeks? Who's new to the last 2-3 weeks? You're just kind of coming here. Awesome, Christian. Okay, good, 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 good. And guys, you might look at this, I don't understand that, right? I don't understand that. But then who here has been with us for quite some time? There's a lot of you who have been with us for quite some time, right? And when we instinctively pulled up this chart, guys, did you instinctively say, I can't buy that and I need to wait? Yeah, guys, it's inherent. It's inherent because it's visual. We see it so many different times that you just see it inherently. And so if you're new to the market, realize, guys, it's going to be overwhelming, right? It's going to be overwhelming. That is normal. You will get to the point where everything becomes visual, just like the veterans here do. And so I kind of read the exact same thing. And Tyler, thank you so much for reminding me to bring on the 200-day moving average, because the 200-day moving average is a significant buying and selling zone. If you see this come back down, make another run, and it breaks out above that 1260 mark, we analyzed this on the coaches show last week, guys, when I said if it can break that 260 mark, and I'm going to go to a 3-year weekly, if it breaks out that 260 mark, you could see it run up even more. I'm going to add that monthly chart we were looking at, and I'm seeing something significant, guys. If it does break that level, you could look at something fairly significant in the gold and the silver market. So definitely keep your eye on that level over the next couple weeks. I'm sure we will look at it. Gino, let's get your take on crude. Get the crude expert out here. Give me your take on crude.
Yeah, Matt, it broke down out of a base up there, and I thought it would rally a little higher on that bounce. And Noah and I were talking, I believe, and I've been talking to a lot of people on oil on this. There's a lot of stuff with OPEC. It's always OPEC in their news on this stuff, And it's found long-term support down here. It's losing momentum to the downside. And look at that moving average you got there, just like we were talking about. The same one. See it? It's
hanging out.
flirting with that one there. It's trying to decide if it wants to sit on top of it or stay below it. What I'm looking for, Matt, is if it breaks above that, will it make a higher high above the last high and find support down here and find a level of support at 48, which, by the way, is still low historically. And if not, if the OPEC doesn't cooperate, you might see a break at 47. You see the 47 down there as a nice support at 47. It's a triple bottom there. And you might want to put an alert there, guys, because that breaks. Matt, you might want to zoom out and look at the next support.
You might want to put a sell order in if it breaks out past that level, because if it breaks that level, it's coming down to $43, $44, and that's a significant movement in a short run in silver. Gino, why is the breaking of the support so important to wait for? Why not just short it at 48.48 when it's right under that 200-day moving average? Why would you say wait for it to break support?
Well, when you see a support like that, especially when it's that perfect of a support at exact numbers, there's definitely buyers going in there and saving it. And look how these hammers form on those supports. 3 times you got hammers and reversals, but the bulls just can't seem to get it up to make it higher highs. It's kind of stuck with the moving average. But when it
and Gino,
support, guess what's below the support? Does anybody know what's below those supports right there?
We know it's below those. It's called stop hunts.
Yeah,
that's what it's called.
Are right below there. People are bullish have their stops, and remember, people are putting support in. They got big orders. So if they get stopped out, that's a huge sell order for them to get out.
Hey guys, especially in the futures market, though, especially in the futures market, Those orders aren't driven by people. Those orders are driven by algorithms, and those algorithms are set to trade one way or the other if XYZ happens or if ABC happens. So if we'll say ABC as support holds, if ABC happens and $47 holds, those algorithms will trigger on the upside. If XYZ happens and support breaks, those algorithms will trigger on the downside. And that's why you saw such a significant break of support back here. Once it broke that support level right there, you just saw those triggers of those orders just drive down in a very quick time frame. And that's why us being prepared for that is very important. It's hard for us to say, okay, I'm going to wake up one day, let's say Wednesday of next week, and I'm going to check crude Wednesday of next week. And if crude is breaking support one day next week, I might short it one day next week. That's not how we have to go about it. 99% of everything successful in trading is research and preparation. Would you agree with that, Tyler?
Absolutely.
I'd say probably 97%. That's close enough.
Okay, we can hit that mean there. We'll go 98% preparation and research. There we go. All right, guys, that's the market update for today. Let's go into the go ahead, Gino.
Quickly, there was a new little feature on the market scoreboard. So we're talking about sectors, and can you just go to the gridiron? It's right below the gridiron. It's a new link. I want to make sure everybody sees it, beginners and advanced. For you beginners out there, we're talking about sector trends. Your go-to right now, until you get quick as the intermediate traders, is just to look at the gridiron we put out. We put a lot of thought into that. The gridiron, it's basically just a football field of what side of the field the sectors are on. I love this thing.
It's Noah's baby. Noah's done a great job with the scoreboard.
Noah and I designed this one day. We were meeting in Long Beach. Yeah. We said, you know what? What if we just had a football field to go with tackle trading and put the markets and everything on it? We said, how about the sectors? So there's the market sectors. The middle of the field's neutral. And what you do is you can kind of see what sectors are bullish trending and what are bearish trending. And you can see which one's really bearish, energy, right? And technology still on the green up there. But they've pulled back. They were in the dark green. They've pulled back a little bit. So if you go back a couple weeks and see where they were, you kind of get an idea of which way they're moving. Now check this out, Matt. Just below that, go down about you'll see there's the major sectors right there, and it'll give you a breakdown of all the stocks in the sectors and stuff. But oops, we just jumped a little too fast. Right there, you see the blue thumbnail of all major sectors. That's just a thumbnail of all the sectors right there. Just a little thumbnail, and you kind of get a glance at the last 3 months of what they're doing. And then if you go back, right below that is something new. Right below that link is something new. This is something I put in there called sector correlation to the S&P. So this is all 9 major sectors and how they're comparing to the S&P. Now, real quick lesson on how to use this. Matt, the question of the day was, is the Trump rally over, right?
Yep.
So check this out. What I do is if I'm trying to figure out how things are comparing since an event like the Trump rally, what was that, November 7th? Down on the bottom, you see how it says 200 days? You just shrink that down until it goes to like 95 days. Right below the bottom right of the chart there. It says 200 days. You just want to grab the grab the left-hand side. Keep that to the right. Keep that, and just grab the left side of that little bar, and you could shrink it down to 95 days.
Yeah.
You want to be on the left side of the bar of the 200. You see where that? Yeah, right there. Yeah.
You want 95?
Pull to the right. Push it to the right.
Yep. Gotcha.
And then now, and yeah,
there.
Yeah, and then just now slide the bar to your right. Now slide the whole bar to your right, so it's today. The whole bar, just grab it. There you go. Now, that's from 8 November till now. And what you're looking at is the different sectors. And all you have to do is, now up there, Matt, you see the S&P 500? That little square? Mm-hmm. If you click on that there and the S&P's flat, that's how everything's comparing to the S&P right there. So the S&P is at 0 right now. Look at all the sectors above it and look at all the sectors below it. So there's still a lot of sectors outperforming and holding up the markets. But you can see that a lot of them are like neutral in there.
Yeah, it's getting close. I mean, it's getting close. You got you technically have 5 sectors above the zero barrier, exactly. 4 sectors below the zero barrier. One just got under there with I believe it was healthcare. So I mean, that's going to happen when the market retraces.
What's that one
right?
on top, Matt? That one on very top. What's that one?
That's cyclicals.
Is that cyclicals or is that a financials?
Cyclicals. No, financials is right here. No, oh, you're right. That is
That's
financials.
why
And
I've
then
been watching
cyclicals is right
financials to
there.
see if they break, because see how much of a leader it was? That's why my eye's been on financials, guys, is because that thing, believe it or not, is really where all the bullishness is. Do you see how since the election what happened? That's the only sector that really took off.
Well, and honestly, Gino, that's the sector I'm probably the most skeptical of right now.
Exactly.
I mean, given the fact that it was such an outperforming sector. I mean, it was just killing it, but it's also been one of the weakest sectors over the course of the last, the last just little bit. I mean, if you come back here to the tools tab here and you go to the trade center, we go back to the heat map. You're looking at a sector that has been so vitally important to the marketplace over the course of the last 4 months, with all the talk of the elimination of Dodd-Frank and whatnot, and the deregulation of Wall Street, which again, I think everybody knows where my head is at on that.
Oh yeah.
But when I'm looking at this sector and I'm saying, okay, you're starting to show some weakness in this sector over the last, we'll just look at the last week, you're starting to see a little bit of neutrality there. And if we look at the past month, you're seeing the weakest sector of the bunch. And so, what goes up fast certainly comes down fast as well. And so that's a sector to certainly keep in mind as well. And I want to switch topics here now, Tyler. And Tyler, I want you to spend about 10 minutes just talking to the class about bull put spreads, what they are, and why they're important why are they the strategy of the week this week for us?
Sure. Okay, so let's start with a question. How many are unfamiliar with the idea of selling options? How many are unfamiliar with the idea of selling option contracts? Okay, Jared, Andy, Rita. All right. So let's start there. Okay. One of the beautiful things about option trading is you have the ability to sell options, which is going to enable you to have a high probability of profit. Okay. Most people that are investors or think about the idea behind investing, they think the objective is to buy an asset that you think is going to go up in value. Would you guys agree with that? I'm buying gold because I think it's going to go up in value. I'm buying silver. I'm buying a house. I'm buying a stock. I'm buying a bond because I think it's going to go up in value. So you have ingrained in your head this idea of buy low and sell high, right? Well, when you get into the world of option trading, there are some strategies that can enable you to do that. I'm going to pop my screen up here. All right. Can you guys see me? There we go.
Yep, you're good.
All right, thanks, Matt. Okay, so one of the unique things about option trading is you have the ability to sell something in hopes that it expires worthless. And the analogy that we use in the real world is it's like you're an insurance company. Okay, so you're going to learn how to become an insurance company when you learn how to sell options. All an insurance company wants to do is write you an automobile insurance policy or write you a home policy, for home insurance, and they don't want you ever to use it, right? So you just pay your monthly premiums. You never use the insurance. They just get to pocket those premiums, and that's it, right? I mean, that's a pretty good business model, right? The idea of obligating yourself to buy the car or to fix the car if somebody wrecks it, obligating yourself to do something that you never have to make good on, right? I mean, that's a great thing. It's a great thing. So you have the ability to do that in the options market, okay? You have the ability to make promises and get paid for those promises and never have to make good on them, okay? So when we talk about selling call options, selling put options, doing all sorts of option selling strategies, really at the heart and core of that, we're trying to be an insurance policy selling something that ends up expiring worthless, okay? So with a bull put spread, we're going to be structuring our trade that's bullish in nature, and we're going to be selling put options in hopes that they expire worthless. Okay, that's the gist of it. And when we structure the trade, we're effectively going to be selling puts that are below the stock price and making a bet that we don't think the stock's going to drop a certain amount. Okay, so you can make bets that you think a stock is not going to drop a certain amount. If the stock goes up, you win. If the stock goes sideways, you win. If the stock goes down, but not too much, you win. Okay, so we're going to be able to structure this with a really high probability of profit. Okay, and by doing a spread, it's going to be cheap. Okay, it's going to be a limited risk trade where if we're wrong, we know what the risk is, and your broker's not going to tie up a lot of money. Okay, so the bull put spread is one of the most popular option selling strategies. Number one, because it's bullish and the market tends to go up over time. And so it's easier to find bullish opportunities in general than bearish in the long run. And number two, it's a cheap trade, so you can do it on all sorts of stocks and not have to tie up an arm and a leg. Okay, so the bull put is one of the first spreads that you learn in option classes where you're learning about spreads. Okay, Matt, before I go into an example, anything you or Gino want to add in terms of just the basic lay of the land with a bull put?
You know, in terms of the bull put, one thing I will say to that, and you know, you've mentioned this in cash flow condors before, is that basically you're like you said, you're acting like the insurance company. Guys, it's always easier to say something will not go somewhere than will go somewhere, and that's in essence what a credit spread is you're basically going to sell an option on the chart where you don't think it's going to go. And if it doesn't go there, then you're going to get paid X amount of ROI. And we'll discuss that here in just 1 second. The difference between delta and theta is you have to be right, and theta is you don't have to be right. And guys, I don't know about you, but in life, I would rather bet on me not being right than being right. Because let's face it, how many times are we wrong? On everything, right? So in trading, it's easier to say that it's just not going to go somewhere. And if it doesn't go there, we get paid, 8, 10, 12, 15% ROI if it doesn't go there, but we'll assess that here in a second.
Perfect.
Oh, Ty, real quick.
Yes,
real
sir.
quick. While you're kind of going through this process, I'm going to be filling out the spreadsheet to show them.
Okay. You want me to take any stock, or do you want me to talk a little bit more about the process of finding a candidate?
No, let's definitely talk about the process of finding a candidate.
Okay, let's do it. All right, folks. So if it's a bull put, I'm betting the stock's not going to go down a certain amount. Hopefully it'll go up. And so naturally, I'm going to look for a bullish candidate. I'm going to look for a bullish chart. Okay, and really you don't have to overthink this. From that perspective, you look for the same thing you look for when you're going to buy a stock, right? So a bull retracement or a bull breakout or some other type of bullish pattern, maybe one that you see us throw out on the reports as a particularly good-looking chart for the week. That's number one. Okay, that's number one, bullish chart. Okay. The other thing that you're going to learn about as you learn more about options is the price that you get paid when you sell an option fluctuates. Okay, sometimes you get paid a lot when you sell puts, sometimes you don't get paid that much. And at the same time in the same market, different stocks are paying different amounts. So wouldn't it be nice if in addition to looking for certain bullish chart patterns, you could also look at an entire list of stocks and see which ones are paying you the most to sell puts? That would be nice, right? So that's where you hear us talking about implied volatility. Okay, implied volatility. There's a lot of ways you can think about implied volatility, but for the perspective of our discussion, I just want you to remember that when the IV is high, you get paid a lot when you sell options. And when it's low, you don't get paid as much. Okay, so sometimes what I'll do is I'll go to my watch list. I've got a couple in here. This is a list of ETFs. And you can actually put implied volatility as a column heading. And I might just sort by implied volatility so I can see which options have the highest IV. Those are the ones where the options are the juiciest, where they're paying me the most. Okay? And that may prompt me to look at that particular ETF or stock to see if there's a chart pattern that I like, that I can build a bull put spread around. Okay, so right now, FXE, which is the Euro ETF, has a little bit higher implied volatility. Okay, so selling options in FXE, you get paid a little bit more than some of its other peers here. XRT has a little bit higher implied volatility. Okay, you get paid a little bit more selling options in there. The ones that aren't as attractive on an implied volatility or from an implied volatility perspective would be like silver down here. Okay, you can sell options in silver, but you're just not getting paid that much. Okay, the S&P. Okay, this you can sell options in, you're just not getting paid a whole heck of a lot. Okay, and so that varies or makes you more attracted to particular stocks over others. Okay, so yeah, we would like to see IV above 50. This is the IV rank indicator, and if it's above 50, that means it's in the upper half of its 1 year range. It's been so hard to find high implied volatility over the last 3-4 months that, you know, we're in an environment where 30 is about as high as you get these days. Okay, and that's kind of what I was talking about with Matt with that spike in the VIX. See, the VIX is a measure of implied volatility. It's kind of the same thing. And that pop we got last week, it's one of the first rises in volatility we've seen. And so these opportunities to sell options when the IV is high have been fleeting. Okay, very temporary. So anyways, that's one way you could do it. I could also go to my stock list and do the same thing there, you know, sort by IV rank and see what's got the more expensive options. Okay, so Jeff, it is a common indicator, but you have to have the code. Okay, you have to have the code. El Guapo, when you're selling options, you don't necessarily have to own the stock. Okay, there's some different implications there that you'll learn more about. With a bull put spread, you don't need to own the stock. Okay, so to keep this discussion just concise, just remember those two things, and Matt wrote them down. I'm looking for a bullish chart or high implied volatility, or better yet, both. Better yet, both. Okay, if I can get both, that's even better. Okay, and so let's do this. Okay, I'm going to pick just a bullish chart. Okay, because the reality is implied volatility is not very high across the board, and so it's difficult to find. Although, let's take a look at Apple. Okay. Apple is seeing a rise in implied volatility in part because earnings is coming up. But I don't know if you guys saw Apple today. It had a big breakout. So we had a big breakout in Apple. This has been basing sideways for quite a while, and you finally got a pop. Okay. So let's say I was considering a bull put spread. All right. What I would look at is I want to sell a put that's below its current price. So currently Apple's at $144. And to do a bull put spread, I'm going to sell a put down somewhere, I don't know, 135, 136, 137. How do you feel about betting that Apple's going to stay above maybe 135 or thereabouts? You see how it's easier to make that kind of bet than to say Apple's going to go up? It's like, I don't know if it's going to go up. I just think based on where it's at, it's not going to go down that much, right? And that's not unique about Apple. I don't even know if we're going to get paid anything to sell that put. I could say the same thing about Tesla. This is another one that was on our report this week. You know, maybe I say, you know what, I think Tesla's going to go higher, but how about I just set up a trade where I make money if Tesla doesn't go below 250, right? So, or, you know, Microsoft looks like it's getting ready to break out. So I say, you know what, I don't know if this is going to go to the moon, but I don't think it's going to go below 63. Maybe I can sell puts down around 63, betting we're not going to go down there. Okay, so that's the basic idea, and what you'll discover is it makes it easier to find trades. Okay, because you're obsessing less over finding a perfect setup and getting it at the perfect time. All that's important, but you know, when you have a question of, well, I just don't think it's going to go down more than 3 or 4%, it's easier to find stocks where you're willing to make that type of bet. Okay, so let's go back to Apple. Okay, so the basic idea is we're going to sell an out-of-the-money put, okay, and we are going to, well, I'm going to add another one here in just a second, but let's first look at this idea of selling an out-of-the-money put, okay. All right, so I'm just going to look at the options that are available, okay? And we're going to go ahead and go to May. I'm going to look at May options, okay? And typically, most people, when they sell options, they're selling like 1 to 2 months to keep it shorter term, okay? There's a higher rate of time decay. The options lose value quicker. You're not exposed for as long, okay? So, but if you get too close to expiration, like April, then there's not a whole lot of premium, okay? So I'm going to go out to May. It's 52 days out. If I were to sell the 135 put, it's a 21 delta. You get about $1.50. You get about $1.50, okay? Now let's just stop there for a second. Let's just stop there for a second. If you take a look at the chart of Apple, what this is telling you is they will pay you $150 if you're willing to bet that Apple doesn't go below 135. Now, first off, what do you think about that? This idea that somebody will pay me $150 if I'm willing to bet Apple's not going to go below 135. It's an interesting concept, right? So if Apple goes up, I win. If Apple goes sideways, I win. If Apple goes down below 135, there's some implications with that. I'm going to lose, okay? But that's the idea. That's the idea, okay? Now, there is an earnings announcement between now and May, and you know that Apple does gap on earnings, so there's some risk with that. And what is the risk? Let's talk about that. Well, when you sell a put, the promise you make is you promise to buy the stock. Okay, you promise to buy the stock. Now, if you did buy that stock, 100 shares at 135, that's $13,500, right? So you may not want to have to buy Apple. You may not be willing to put up all that money, okay? But that's the bet you're making. So what we do with a put spread to limit the risk is we just buy protection at the same time. So I sold the May 135 put, and that obligated me to buy the stock at 135. And then I'm going to buy the May 130 put, which gives me the ability to sell the stock. I have the right to sell the stock at 130. So then it doesn't matter how low the stock goes or how wrong I am. Really, my risk is just $5 minus whatever initial money I get up front. Okay, so that's what a spread does, is it limits your risk. You sell the 135 put, and just in case you're wrong and to limit the cost, you're going to buy the 130 put to protect yourself. That's called a put vertical spread. So when you build the trade, you sell the 135 put, you get about $1.50, and then in Thinkorswim, the way you add in that protective put is you hold down the control key, and you click on the ask price of the 130 put, and then it puts them together. And it says, oh, you want to sell a vertical spread. Well, you only get 70 cents credit now instead of $1.50, but you drastically reduce your risk, okay? See, if you were to just sell this put naked, in a margin account, hang on, let's sell one of these. Almost done, Matt. In a margin account, they make you put up a fair bit of money, about $2,000, okay? And that can go up if the stock drops. Okay. The beautiful thing about the bull put is when I set up that bull put spread, you're going to see the cost is only about $430. Let me fix this for you. All right. So the cost, that's wrong. I can't get it. I'll fix it here. Boom. And boom. There we go. 71 cents credit. You do a one lot. The cost is going to be $429. So the bottom line is it cuts the cost quite a bit. Okay, it cuts the cost quite a bit. So now you're making $70 on $429. Okay. And if you look at the return on investment, $71 divided by $429, that's a potential return of 16.5%. Okay, that's if you're right. Could be wrong. If you're right, that's potential 16.5% return, which is another way of looking at this. Okay, so now you could say it this way. You could say someone will pay me a 16.5% return for my willingness to bet that Apple's going to be above 135 in May. I get a potential 16.5% return on my capital if Apple stays above 135. Those types of trades are in the market all the time. I don't know if you're going to be right or wrong, but those potential payouts with high odds of success are available.
Well done, Tyler. How'd Tyler do, everybody? Awesome. Definitely sexy. That definitely meets the sexy criteria for the tackle trading group, no doubt about that. I want to share now my screen, guys, and then we'll do our favorite 10 minutes of the week here in just 1 second. But as Tyler was going out there, guys, and kind of analyzing these, I was filling out this in the Tackle Theta research spreadsheet. And I was comparing the different two, the naked put versus the bull put spread. And I think you're going to see why we do prefer bull put spreads over naked puts, especially on high dollar stocks. Here's the naked put that Tyler did in terms of the spreadsheet. We're selling the 135 strike price. We have a delta of 21. We have a 5.5% buffer, but compared to a 30-day number, we have a 3.2% ATR buffer, which is in the average. Our net credit is $150, but we have to put up $2,004 in buying power to get that $150, which is a 7.5% return over the 52 days, but only a 4.3% return over the 30 days, which is slightly lower than what we typically are looking for. So that's that trade, But in the bull put, we come in here and we say, okay, we fill out the same information. We're going to sell that same 135 strike price in the same May with 52 days of expiration. We're going to have 21 delta. We're then going to buy that 130 strike price. We're going to lower our buying power down to 429. We're going to have a $71 credit, and now we have a 16.6% return versus a 9.5%. So the question I have for you guys is, would you rather do the naked put or would you rather do the bull put when you see the numbers? The bull put is more efficient, no doubt about it. So did you guys learn something as we were going through that discussion?
That's
awesome. Well done. And yes, guys, as valuable pro members, every single one of these spreadsheets are available for you. Now, it is that time. We're not going to shortchange you guys. We know the drill. We know you love it. It's rapid fire time, ladies and gentlemen. Now, guys, we got a record, and what's the record number? We got to come back to this. We got to settle on that record number. Is the record number 33? We got to settle on this. Is it 31? There's some disagreements. We're going to split it. We're going to put that record number at 30. I think it's 32, to be honest with you. Is it 33, Anthony? Did we get 33? I'm going with Anthony on this. Did we get 33 that day? I think we nailed 33. I think we did nail 33. Now, to set the stage, Gino and Tyler. Okay, we got 10 minutes on here. Okay, we got 10 minutes on here. We're going to start. And guys, I want you on your A game. Okay, I'm going to go down. Gino, Matt, Tyler. You guys got 1 second to start analyzing. Paul, 30 honest, 33 dishonest. I'm not saying if there was cheating. There was some confusion at the end. We powered through it. We're setting the bar at 33, and we're going to try to get that. So I want you guys to keep track of this. We're starting right now. And let me get the list here so we can go down the list. We're starting with WBA and the timer set. Okay, let me get my screen over here. Gino, you are the first to go here. So let me get my WBA. Let's go to the chart here.
Walgreens
and
Alliance.
WBA rapid fire starts, Gino.
Okay, long-term neutral in a big range between 88 and 80, but right now I'm daily. I am bearish. Looks like it's going to do a swing high around 84.5.
I like it. Let's go, Matt, and we got Bed Bath & Beyond here. Bed Bath & Beyond, bearish downtrend coming back into resistance, would not fight the daily candle. I would be looking for some type of smaller candle at some resistance level, downward movement in price. That is a shorting opportunity. Tyler, we're going to go with 3M Company.
Triple M, like the pullback, bull retracement. Nothing not to like. Nice reversal candle today.
Nice. And net tease, Gino.
Excuse me, NetEase bullish. It pulled back to the 20, looking for a break above today's high and maybe a trigger above 299 for a bullish.
On an expensive stock, you might want to look at those bull put spreads we just talked about. Let's go with KRO. KRO is me. Forming a little bit of a high base pattern here, a little cup and handle you could talk about. A breakout of $16 with a close above that level would be a trigger on the buy side. Next, we're going to go with Tyler with BHI. Baker Hughes.
Yeah, BHI was a bear retracement. I don't like that bullish candlestick today. I think that invalidates the bear retracement there. Too early to buy, too late to short. I pass.
Awesome. BHI, we're going to go with Gino with Boeing, BA.
BA, Boeing, Aerospace. Nice long-term pullback here, but it's flirting right on the moving average. It is pulling back, did a swing low today. The trigger to get in would be above today's high. Again, expensive stock, guys. Wait for the trigger if you're doing those bull puts.
MKC, we're going to go with McCormick with Matt. Got a huge down day on earnings. You would not find it. Was bullish before then. This is a stay away for me. It's a great trend before today. Now we got the earnings report on today. We'd have to see what's going on there. I would give it a few days before I assess that at all. Advanced Micro Devices with Noah. Not Noah, with Tyler. Sorry, Tyler.
That's all right. Do a good no impression. AMD just consolidating right now. This has had a lot of big moves over the last year. I would probably wait for a breakout over 1450. While it's chopping sideways, I wouldn't touch it.
Awesome. Good credit stock there. Gino with Hess Corporation.
Hess Corp. That's easy. That's a bearish daily trend. And it found long-term support, but waiting for the swing high to enter this as a bear trade.
ULTA, that would be me on Ulta. My daughter's favorite stock. It kind of makes me sad, but this is a buying opportunity. Got some increasing momentum on the trend after the earnings announcement. Had a pullback, got a trigger above. That is a prototypical bullish retracement with the confirmation. We all know what that means. Now we're going to go with Tyler with NSC.
Daily downtrend. This will form a bear retracement. Watch for maybe another update or two. Reversal candlestick, and then it would be a bear retracement. Wait for
Love it. CVS, Gino.
CBS. Daily.
CVS.
Oh, CBS. Oh.
V is in victory. Yes.
CVS. Yeah, that is definitely looking kind of boring to tell you the truth, but it is a daily bearish trend, and looking for some kind of trend is what it's doing. But my breakdown point would be 77.80ish below that support for a bearish trade.
Awesome. Let's go with AT&T, and that is me. I'm looking at a whole lot of neutral here, a lot of what AT&T has done for the last 35 years. I don't see any reason to play this one way or the other right now. This is kind of just a wait and see type approach for me. Let's go with BABA, B-A-B-A, and that's Tyler.
Little messy up here. I think you hope that it goes sideways for maybe a couple more days and look for a breakout over the highs. 109 and change. Bull breakout. Yep. Nice uptrend, but messy.
Nice. Gino with DB. Deutsche Bank.
Deutsche Bank. Definitely bearish and a lot of gapping going on there, guys. I stay away from stuff like this. But yeah, that's definitely bearish. I don't like to trade gapping stocks like that. That's gapping personality dysfunction right there. But look for the swing high if you do.
Going to happen to a better unethical company. Let's go with Ford with Luke. Ford, very bearish right now on Ford. Broke support levels at 1220. As you saw those trigger to the downside. I expect this to form a bearish retracement based on the technical setup, and then we'll look to perhaps enter a bearish trade. But I certainly think there's more bearish stocks out there to trade. Let's go with Tyler with PSA, Public Storage.
PSA looks similar to IYR, so same sector as the real estate potential head and shoulders pattern. It's pretty messy. I think I'd stay away.
Stay away. INTC, the Intel with Gino.
Intel, daily slow melting bearish trend there. This is one of those kind of boring. Not a real good player of mine. I'd probably stay away with this till it finds a better trend. It is in technology though, which is a hot sector.
All right. All right, next is TLT, the Treasury bond here. Treasury bonds hit upon resistance. Look for a downward movement of price. Got a nice little piercing line candle, which is a very bearish candlestick pattern at your resistance level. Look for that to come back down into support. You got the 50 and the 20-day moving average, as well as a historical support level right around 118.50. Next is JetBlue, JBLU, and that would be Tyler.
I call that a breakout today. Yeah, nice breakout. It had confirmation over the $20.50 resistance. Yeah, I'd look for that to continue higher. 22 or so be your target.
All right, let's go with Gino with Marriott.
Marriott is definitely on a bullish trend, overextended, hitting some recent highs there. If you're bullish on this, don't chase it. Wait for a setup, a pull back to the 20 at least, and a swing low.
Yeah, patience is a virtue, no doubt. That looks like it will form a good bearish, bullish retracement, though. 3L Technology. You're looking at a bull area right here, forming a hammer candle followed by a big upward movement in price. That is forming a bullish, engulfing candlestick pattern. But I am very concerned about the consolidation. You see this 20-day moving average starting to come back down. Look at the market. Same type of concern we had on the market. You're going to have on 3L Communications here. Next, let's go with URI and Tyler.
URI, so it's at the lower end of its range. It filled its earnings gap. I think you got to wait for a breakout topside. You got a series of lower highs on that. So I would not be bullish until it takes out 128 and change.
Nice. We got UCO, and we got 3 minutes left in rapid fire. This is Gino.
This is one of your pro shares here, guys. Be careful of it. It's also got gapping personality disorder, and be careful with these because they are, got to know your ETFs. But that is bearish. Long-term support, though, waiting for a bear rally for a swing high to go back to bearish.
Nice. Natural gas, and that would be me. Gas has formed a little bit of a bullish type formation. It got up above the 20, 50, and 200. That is obviously bullish. It has gapped up again. Look for this to continue to rise after it broke out of an ascending triangle. But the biggest thing is it got up above all of those levels of resistance / support in your moving averages. Bullish on that for me. WFT, that would be Tyler.
Yeah, nice bounce this week. Tough to chase here, though, because you're now in the middle of support and resistance. So I'd potentially look for that to continue up towards $7. You got support down at $6, but really you should already be in this if you were buying that dip.
Schlumberger, SLB, this would be Gino.
Schlumberger, okay, yeah, that's in the energy sector. Of course, it's bearish because that's part of the sector, energy and oil. And yeah, that's a tight little range there. Just a daily trend. There's better trades out there, but yes, you can play this setup.
AMGN, and that would be me. Gap down, I'd have to look at that coming right smack down into the 200-day moving average. That is a long-term bullish type setup at the 200-day moving average, but I'm a little concerned about that gap. I'd have to look into that gap before I did anything with it. Let's go with the euro dollar here. Let's go with a Forex parent. We're going to go with Ty.
Nice trade, yeah.
You want me with the euro dollar. All right. You found resistance there, the 200 MA. I wouldn't buy it here. I think you want a couple more down candles and then maybe a bull retracement.
All right, we got 1 more minute to go here. We're going to go with Lockheed Martin and Gino.
Yes, Lockheed Martin, again, another aerospace. That was a swing low right there, but I don't like the trend. It's kind of sideways. I'd wait for a breakout above the 273 area. Another expensive stock, guys, to go put your eyes on a credit spread. Again, check out the journal when you do that to make sure you get the credit on these. But there you go, guys. An expensive credit.
And we're going to go with Halliburton, and that is me. Halliburton coming down into that 200-day moving average, underneath that 200-day moving average. I would kind of shy away from that right now. I'd like to look at a better setup than that. And ladies and gentlemen, that was rapid fire. How many did we get? No cheating on that one either. That was 10 minutes. We got 32. Oh, that was awesome. That is so fun, guys. That's so fun. Do you guys enjoy when we do that? When we just do this rapid fire, we just boom, boom, boom. Oh man, I get all jacked up. Okay. Well done, Tyler. Well done, Gino. Great show, guys. We are not traveling this week, but next week I will be in Orlando, Florida. If you want to come check out the show down in Orlando. Tim, who is not here tonight, he is going to Hawaii, that lucky little sucker, going to Hawaii. Check out the Technical Analysis 101, the 7th step. Check out the scouting reports coming out. Check out the everything we're doing over there at Tackle. And guys, get in the clubhouse. Let's make one goal this week. Everybody has to participate in the clubhouse. And yes, Christian, I feel so bad for him. It just my heart hurts for him right now. All right, guys. Thank you guys so much. We will see you next week. And if you have any questions, email team@Tackle Trading. So if you're looking for the spreadsheets, you can go get them over there at Tackle Trading. You can always email Cam at team@Tackle Trading. And we will be with you here again for a live show next Tuesday. Awesome show. Awesome job, guys. And thank you so much for being the best part of TackleTrading.com, guys. We'll see you next week.